Hi, Steve Walker again, Promise Money. Today I'm going to talk about flat rates and explain to you why they are different to normal rates. And you need to know this if you're thinking of borrowing on a flat rate, because you could come nastily unstuck if you don't understand the difference. The reason I say this is that when you're talking to flat rate lenders, they quote their flat rate, but they don't tell you it's totally different to the rates that you're used to. And they don't. And if you ask them if there's any settlement figures, early settlement charges, they'll say no, there's no early settlement charges. And in their world that is true, but in your world it probably isn't. So you need to understand the difference, and I'm going to try and explain that to you. So flat rates typically used on asset finance, so if you're buying plant, machinery, that sort of thing. And there's nothing wrong with them, you just need to understand the difference so you can make an informed decision. But there are some lenders that are using them on mortgages. And that's really, really dangerous, because when you take out a mortgage, you expect to be comparing rates fairly, and a flat rate at 7.5% probably equates to a normal rate at around about 12 or 13. So if the lender says, yes, it's a 7.5% rate, sir, and there are no early redemption charges, if you compare that to a mortgage or a normal loan rate, it's a lot higher. And yes, there are early redemption charges. They're just dressed up differently. Right, so let me take you through it. Okay, well, take a look over my shoulder and I'll try and explain the difference between how flat rates and standard rates work. So imagine this is your normal mortgage or loan where you've borrowed £100,000, 14% interest rate, 60 months term, and your payments are just over £2,300 per month. And as you'd expect, each month you make that repayment and that reduces your balance a little bit. So you've got a reducing balance coming down here. Every month that amount is paying off a part of the interest for that amount and part of the capital. So the interest reduces each month because it's charged on a monthly basis. So you've got a reducing balance. Here's the difference with a flat rate. All the interest is added onto the loan at the beginning. So here's a scenario where I'm saying, right, this is at 7.5% flat. Now, a 14% rate on a normal mortgage or loan cannot be compared to 7.5% flat. You're looking at that and thinking, well, that's a lot cheaper than that one. It's not. £100,000, 7.5% times 60 months is 2,291 against 2,326. There's not a big difference, like there's £30 difference in the monthly repayments, and it's nearly half the interest rate. And here's why. The way flat rates work is that they'll take this £100,000 and they'll multiply it by 7.5%. So I'm tapping away. I should be able to do this in my head, shouldn't I? That's 7,500, and then they'll say, right, so interest in year one is 7,500. You play the same in year two, same in year three, same 4, and same year 5. So multiply that by 5 years, and they're saying, right, so what we're going to do right at the beginning is we're going to add on £37,500 worth of interest. So the day that loan completes, you owe 100k. The day this loan completes, you owe 137,500. Okay, you're following. So as your payments are made, your reducing balance starts £37,000 more. So if you were to pay that loan off after 2 months, you'd expect to pay less than £100,000. If you pay that off after 2 months, you're going to be paying close to 137,500, depending on the lender. Now, the thing is, with flat rate lenders, most of them say, yep, you're going to owe us the whole amount, the capital, the amount you borrowed, plus the interest under the agreement, because you're settling it early. We might give you a rebate. Now, some might give you a rebate of a few months. Some might even rebate half of that. And there's one lender I know which will only charge 1 month's interest on this, but you can't rely on it because all of these agreements are different. You don't know which lender you're going to finish up with. So the key thing here is, if you take a flat rate loan, it might cost you less, but you've got to be in for the long term. You really need to be thinking of this asset that you're buying, that you're going to keep it for that term and not look to get out of the agreement early, as you might, for example, on a normal loan or a normal mortgage. It's attached to the asset, it's attached to the life of the asset. That's the way you should view it. Doesn't mean that asset finance is a bad thing, because the rates, it can cost you less over the term. And sometimes with these products, you might need to offer a personal guarantee. With these products, you might not. So it all depends on what's available for your circumstances at the time. So that's how it works. The asset finance interest rate is front loaded, added on, and by the way, I've got that repayment. It's 137,500 divided by 60. That's how you get to that number. So that's how asset finance works. Front loaded interest. Don't really want to be paying it off early if you can help it. So if you've managed to follow that, you'll see that a flat rate interest rate, even though lower, significantly lower on paper than a normal rate, could actually cost you an awful lot more. And because of the way the interest is all front loaded at the beginning, a lender could say to you, well, there is no early redemption charge, and they mean that, but you still have to pay everything required under the contract. So if you're borrowing for 60 months and the contract is a 60-month contract where you are paying interest spread over that whole term, and you settle it after 3 years, potentially you've got to still pay a further 2 years interest. Okay. Now, as I mentioned, some lenders will give you a rebate on that, but a lot of them won't, or will give you a very small rebate. You might, with a few lenders, get 50% of the interest back, and with some you might get more. But the lenders that will do more are the ones which are very picky, probably don't offer you such good terms in the first place, etc. So all of that has to be balanced and has to be taken into consideration. I think the key thing is, if you're taking out asset finance, go into it with the mindset that you're going to be keeping it for the full term of the repayment period for the life of the asset. And remember, I did mention earlier, there are some mortgage lenders, I'm not going to mention their name, but they'll say, need a commercial mortgage? We've got some great products and we can do it really, really quickly, and we're less fussy than other lenders. They are less fussy because they are charging you a flat rate. So when they say it's 7.5%, they mean 14. And when they say no early redemption charges, they mean you've got to pay the entire interest through the loan through the life of the loan. It's like buying a photocopier. You know, you want to get out of that loan, and you've still got to pay all of the interest. So let me summarise. Flat rates are great, great products for asset finance. They work really, really well. Be prepared to keep the product for the life of the loan, really. If you are thinking of settling it early, you need to explain that at the outset so that an appropriate product can be found for you. And that might mean that you pay a little bit more each month, but the early settlement charges, or the total amount you'll pay when you come out of that product if you settle early, could be lower. So make that clear at the outset. You can't compare a flat rate with an APR. They're two totally different things, calculated in totally different ways. And don't be misled by people who try and kid you that they're not. So if you are thinking of taking out asset finance for plant, machinery, vans, etc., equipment, check out our other videos. There are different types of assets, hard, medium and soft assets. They're treated in different ways. Different lenders will like different types of assets. So check out our other videos. But if you need any more assistance, do get in touch with Promise Money. And don't forget to subscribe, share, like our videos, and look out for more of the same. Thanks a lot. Bye-bye.